Today we're going to be going over 5 key tips on how to save thousands of dollars when it comes time to renewing your mortgage. Welcome back, guys. It's Tom here from Off Mortgages. Thanks again for tuning in, and as always, don't forget to hit the like button down below and hit subscribe. That way you don't miss our weekly videos on all things mortgages. Now, how does a mortgage renewal work? When coming up to the end of your term, your current lender is going to be sending you a new term as well as new conditions and a new interest rate. And all you have to do is sign that paper, send it back to your lender, and you're all set for new term. But is that your best option? Maybe, maybe not. It's certainly your easiest option, but it's not going to be the option that potentially saves you thousands of dollars. The way to go about doing that is by exploring all options. So starting out with tip number 1, start the renewal process early. Best practice is to start the process around 3 to 6 months prior to maturity date. And the reason for that is you definitely want to have the time in order to explore all the options, because you don't want to have, say, 1 month left to maturity and potentially not have the right amount of time to find the best option and close that new term with a new lender, for example. So my advice would be at the 3 to 6 month mark, the minimum 3 months away from maturity date, definitely go out and seek advice from a mortgage broker, and he or she will take it from there. Tip number 2, assess your overall big picture. You need to be looking at your present and your future goals, as well as your current situation in terms of what your family or your personal income or debt might be looking like. For example, if you've accumulated a decent amount of debt, such as a line of credit or credit cards or even student loans, then this would be the perfect time for you to actually absorb all those debts by taking equity out of your home and doing an actual refinance at maturity date. That way you don't have to pay that penalty of breaking your mortgage down the line in the future if you ever choose to go that route of refinancing. Another reason is you definitely want to look at what you plan on doing in the future in terms of goals and ambitions. Say, for example, you're an aspiring real estate investor and you have quite a bit of years chipped away at your current mortgage. One way to go about succeeding in real estate investing is by stretching out your amortization with your current home, and that way you lower your monthly payments and it allows you to be able to qualify and afford future properties. There's many reasons why you might want to go about going a different route with your mortgage. That's why it's important that you do take the time to sit down with your family if you have a family, or if it's just yourself, just write everything down that might pop up in your head and then go seek help from a mortgage broker, and then he or she will actually give you the advice that you need. Tip number 3, don't be fixated on the rate. Yes, interest rates are very important. However, it is not the end-all be-all when it comes to picking the right mortgage product for you. Some other things to consider when looking at your options would be what kind of prepayment privileges the lender might have, what kind of penalty you're looking at in the future. That's a whole nother conversation to have, whether we go fixed or variable rate. The penalties do vary, especially when going from a big bank institution versus a monoline lender. So these are all things that you need to discuss with your mortgage broker, and not just fixating on the rate. You'll actually in turn save yourself thousands of dollars in the future by saving yourself on things like these prepayment penalties that you might come into in the future. To give you a quick example, if you're someone that plans on locking into a 5-year fixed rate, but you end up moving in 3 years, so you're going to be breaking that 5-year fixed rate, you're going to be incurring a hefty penalty. So let's say your mortgage was $500,000 and you go to break that mortgage and you have a 5-year fixed rate with a big bank such as Scotia, TD, RBC, the list goes on, then you're looking at about 5% of that $500,000 that you're going to be paying just to pay that prepayment penalty when breaking that mortgage. So you're going to be looking at $25,000 just to break that mortgage. Now, if you locked into a variable rate and you go to break that mortgage at the 3-year mark in that 5-year term, you're going to be looking at about 0.8% of the total mortgage amount, which would be the prepayment penalty. So going back to that $500,000 example, you'd be paying about $4,000 in prepayment penalties, which is a whole lot different than $25,000. So those are only 2 examples of key components when it comes to mortgage products. So that's why it's important that you're not just fixated on how low your interest rate is. Tip number 4, avoid locking into high penalty mortgages. Now this tip is kind of a continuation of tip number 3, only that we're focusing in on high penalty mortgages. So what do I mean by high penalty mortgages? What I mean is, going back to that last example, the fixed versus variable discussion has a huge play on how much you're going to be paying for your prepayment penalties, but there's also a couple other factors that go into play as well. The first factor being how much of a length of the term you have left when it comes to breaking your mortgage. So say, for example, you have 4 years left in your 5-year fixed rate mortgage. You're going to be paying a significant more amount versus, say, you had 1 year left in your mortgage when it comes time to breaking. So what does that mean for you and strategizing? That simply means if you are someone that plans on moving in 2 or 3 years, you may not necessarily want to be locking in to a 5-year term. Of course, if you're going variable route, it wouldn't make a whole lot of difference. But if you're somebody that loves going with a fixed rate, then you definitely want to go with a shorter term mortgage if you plan on breaking that mortgage in a shorter amount of time than 5 years. So that's another discussion you'd have with your mortgage broker, is if you'd rather be going a 2, 3, or 4 year term. The second factor when it comes to paying higher penalties is which lender you choose. Now, if you're going with a big bank such as Scotia, TD, RBC, BMO, then you're going to be paying a way higher interest rate differential penalty versus a monoline lender such as First National and MCAP. Now, this isn't to shy you away from going with a big bank, because there are several benefits to going with a big bank. However, if you're somebody that loves going with a 5-year fixed term, then it's definitely advisable to go with a monoline lender. And tip number 5, make sure you work with the mortgage broker. When it comes to working with the mortgage broker, there really aren't any negatives. They're not going to be charging you a penny for their service, and also they're going to be giving you the best options available. And the biggest difference with going with the mortgage broker versus just renewing with your current lender is the fact that you have the options. Worst case, at the end of the day, if your current lender ends up being the best decision, then you may have wasted a couple hours of your time, but at least you know that you have explored all the options and that you found the best option for you, so that way you have a peace of mind. Yes, working with the mortgage broker means you're going to be having to go through the approval process again. However, at the end of the day, you have to do what's best for your mortgage and what ultimately would save you the most amount of money. So there you have it, guys. Those are the 5 key tips in order to save you thousands of dollars when it comes to your mortgage renewal time. As always, guys, thanks for watching, and I'll see you guys on the next one.